Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Carvana's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Carvana is an online used car retailer. It performs almost all the functions a physical dealer would offer: buying and selling cars, accepting trade-ins, and also financing options. It is the fastest growing online used car dealer in the US, and it is known for its multi-story car vending machines. They are the fastest company to sell 1 million vehicles online, which took them about 9 years. The company is headquartered in Tempe, Arizona, and was founded in 2012. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, and London Stock Exchange. Let's get started with the model. This is a large cap company, 24 billion market cap. They're trading at $135 a share, and they have 178 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. As you can tell, they are in ultra growth mode. They have negative free cash flow every year since they're investing back into their business to grow it. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's also negative every year. Revenue is the sales for the company, and that looks amazing, going from 2 billion up to almost 13 billion. This is their income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew from 200 million to 2 billion. Below that is their operating expenses. Their big operating expense is marketing. Gross profit minus operating expenses give you your operating income, which is negative every year. Below that is the interest they pay in their debt, and that's been going up each year. It's 176 million in 2021. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. Then you have your pre-tax income. They don't really spend much in taxes since they're not making any money. And the bottom line of the income statement is their net income, which is negative every year. This is the company's income statement from their 10K. Most of their revenue comes from used vehicle sales. That was 10 billion in 2021. They generated nearly 2 billion from wholesale. Example is when they sell cars in wholesale auctions, and 1 billion in other. Most of this includes the gains when they provide financing to the consumer. So their revenue is 13 billion, up from 4 billion. So it more than tripled in 2 years. Their cost of revenue is 11 billion, so their gross profit is 2 billion. And that went up 4x from 2019. Their gross margins are 20%. That's gross profit over revenue, which is worse than a market median of 37% and a market average of 41%. But they're still a pretty young company and they're growing, so over time their margins should improve. They spent 2 billion in SG&A. This includes marketing and payroll for support functions, and 176 million of interest on their debt, which more than doubled from 2019. So they do have a net loss every year. But their earnings per share is improving. It was negative $2.63. In 2021 it was negative 163. And they're increasing their shares outstanding each year. The average in 2019 was 47 million, then 65 million, then 83 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. And they had their biggest negative in 2021 at negative 2.6 billion. And their capex is growing each year from 144 million to 557 million. This includes the vending machines for their cars. Also, some of their technology goes into capex. Operating cash flow minus capex give you your free cash flow. And of course, they have negative free cash flow each year. They're funding their business on equity and debt. They issued 170 million of equity in 2018, then 300 million, then 1 billion. They issued over 16 billion of debt in 2021 and paid down about 13 billion. Every year they issue a little more debt than they pay down. This is the company's operating cash flow section from their 10K. And the way you calculate operating cash flow, you start with your net loss, then you add or subtract the non-cash items on the income statement, then adjust for changes in working capital. They had an accounting loss of $300 million in 2021, but lost $2.6 billion of cash flow. That's mainly from buying inventory. They spent over $2 billion of inventory. When they sell the inventory, then it'll be a cash inflow in that accounting period. If they have difficulty selling the cars or are forced to sell at a discount, then that could really negatively affect the company. If I wanted to buy a car with them but couldn't afford it, they may give me a loan of $30,000, then I have to pay them back monthly payments over the next 3 or 5 years. So that's why there's a cash outflow of $7.3 billion on receivables. The reason there's a positive $7.4 billion is because they sell these loans to banks or package up the loans and issue a bond. That's called a securitization. So this reduces the risk of the person not paying. The risk is transferred to the investor or the bank who took the loan. The main risk for this company is not being able to sell its inventory or having to sell at a discount. Look at their revenue growth since 2015. They're growing at an unbelievable pace, and the forecast is for their revenue to continue growing and their operating cash flow to remain negative. In my model, they have negative free cash flow through 2024, and it's positive for the first time in 2025. This is their investing and financing sections from their statement of cash flows. In their investing section, most of it is purchase of PP&E, $557 million. They also bought some investments in 2021 of $126 million. That $126 million was the purchase of convertible preferred shares in the company Root. Root is an insurance company with a market cap of $500 million. This is their ticker, Root. In their financing section, they added $15 billion on a revolving facility. They paid down $13 billion. They issued $1.7 billion of long-term debt, so they had a cash inflow of $3.5 billion. Last year was a cash inflow of $1.2 billion. They also added $1 billion of common stock last year. They didn't add any common stock in 2021. This is the equity section on their 12/31 balance sheet. They have $300 million of equity. They raised $800 million from selling their business, and they lost $500 million from running their business. Let's look at the capital structure. $300 million of equity, $5.8 billion of debt. They're 5% equity, 95% debt. So they're pretty leveraged. This red line is their debt balance since 2015. So you can see it's been really going up because they need to add debt to buy the inventory. Their equity balance has been pretty low. At one point in 2020, it was higher than a debt balance, but they bought a ton of cars in 2021, so their debt went up a lot. The reason their cash didn't go up that much is because they used that debt to buy cars. Then either they sold those cars to individuals or they're sitting on their lot. We'll look at their balance sheet in a little bit, and I'll show you where their cars are reported. It's in the current asset section. I gave them the highest whack on Finbox of 9%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $64 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $46 billion. We divide that by 178 million shares, and we get a calculated stock price of $260. They're trading at $135, so they're trading at a 48% discount. It's a strong buy according to the model. Their revenue is projected to grow 23%, so I grew their revenue 23% for the next 4 years. That's how I got their future revenue estimates. The average company in their industry converts 15% of their revenue into free cash flow. To get their 2025 free cash flow, I multiplied their revenue by 15%, and I assumed they would have negative free cash flow up through 2024. The website Simply Wall Street is a lot higher than me. They're close to $500. They're saying it's 74% undervalued. 18 analysts priced this stock, and the average price target is $217. The low is $130, the high is $375. This company IPO'd in May 2017. And the stock was growing little by little for the first few years. And then it crashed in COVID. Then it ran up really high to over $350. It's down about 60% since that peak, so it could be a great time to get in. If you bought the S&P 500 when this stock IPO'd, you'd be up 82%. And this stock is up almost 1,200%. Even after the big drop. At one point it was up over 3,000%. They sold cars in 9 cities in 2015, and it grows every year. It's up to over 300 now. And they're growing their vending machines as well every year. They're up to 30. Look at their car sales. It went from 6,500 to 425,000, which is a 74% growth from 2020. And they're making more money per car. It went from 200 to over 4,500. This is their vehicle sales per quarter. Every single quarter it's increased. It's just phenomenal growth by this company. They have a really high beta, 2.35, so the stock is really volatile. It moves more than 2 times the market. It's gone down 50% in the past 52 weeks while the S&P is up 11%. The 52-week low was 98, the high is 377. And the stock is on a major decline, trading below its 50-day and 200-day moving average. 4 to 5 million shares are traded each day on this stock. It looks like most of the shares are held by institutions, and it has a high short percentage, over 17%. So there might be more downside coming. They add lots of employees each year. They employ 21,000 people. This is all the insider buying and selling in the past 12 months. The date, the person, the shares, and the price. 93% of the company is held by institutions, 6% by hedge funds, and under 1% by individual insiders. The biggest shareholders, T. Rowe Price at 15%, then Bailey Gifford, Delaware Life Insurance, Fidelity, and Tiger Global. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a good price to sales of 1.9, that's stock price of a sales per share. They have a really high price to book of 78, that's stock price of a book value per share. Let's look at their non-current assets. They have $1.6 billion of property and equipment, $369 million of operating leases, and it looks like most of their growth is organic. They don't really have much goodwill. Let's look at their non-current liabilities. $3.2 billion of long-term debt and $360 million of operating leases. They have a good current ratio of 1.7, that's current assets over current liabilities. But they have lots of inventory, lots of cars, so their quick ratio is 0.6. Let's look at their current assets. $400 million of cash, $233 million of restricted cash. According to the company's 10K, restricted cash is a cash they're required to hold for the revolving facility. $200 million of accounts receivables, this is how much money is owed to them. $356 million of finance receivables. So there are some loans they can't sell to banks or put into a securitization, so they have to hold it on their balance sheet. They have $3.1 billion of vehicle inventory. When they set up a securitization, they may benefit from any equity left over after the securitization is paid down. That's about $400 million. Let's look at their current liabilities. $656 million of payables. This is how much money they owe others. They owe $2 billion on a revolving facility and $150 million on long-term debt. They lost $3.2 billion of cash flow in 2021, and they have $2 billion of working capital. So it looks like they're going to be short $1.1 billion. So they're going to need to add some debt or equity to get through the next 12 months. The best way to look at ratios to compare them to companies in the same industry. There are 50 companies in the same industry as Carvana, and Carvana ranks 8th in market cap at $24 billion. The average is $45 billion. Although a lot of these companies don't really do what Carvana does, they're just put into the internet retail category. So most of their numbers are a lot worse than average. Except price to sales, they're doing better on price to sales, and their revenue growth is unbelievable. Although lots of companies in this industry have really good 3-year revenue growth. So to summarize, I have them trading at a 48% discount, and they're doing an amazing job at growing their revenue. But if they continue losing money each year, it is possible the stock will decline. But if they continue taking market share, they will be the biggest company in this industry. There does seem to be a lot of great potential, but I think it's a bit risky. I rank their free cash flow as 1 out of 10, their revenue 10 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.